Hello, everyone, and welcome to the first of 5 2022 outlooks. Today, we start off this series focusing on equity, and it is my absolute pleasure to be joined by Ben Laidler and Gil Shapira. We have a fantastic session lined up for all of you. We will go through, well, various things. I'm just going to try and drag up the slide for you all, but we will focus on what you can see here now, the remarkable recent rallying context. We'll also look at the big picture drivers. We'll also go and look into US exceptionalism versus the rest of the world opportunities, cyclical sectors to lead, but technology will remain core, and also the key investment themes to consider. So we've got loads of content for you. We've also got free polls. So as with always, the more engaged you guys are in the chat, in the Q&A, the more interactive it will be as well. So I'm really looking forward to that. And the community we've got here is fantastic, and long may that continue. So feel free to comment throughout. We've got time for a Q&A at the end. So I'll be keeping a close watch on the questions there to put to both Ben and Gil. Before we get started, I want to just bring in the disclaimer, of course. So just to note, well, I'll read it out. I know it's on the console for you, but just to note that CFDs are complex instruments, come with high risk of losing money rapidly due to leverage. 68% of retail investors lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Now, this presentation is a marketing communication, should not be taken as investment advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instrument. So basically what we're doing here, we love free education. We believe it should be for everyone. And this is why we're putting on this webinar and the coming webinars as well. Last thing we want you to do is to say, oh, look, these guys said go and put all your money into Bitcoin and now I've lost it. So, we want to put on this free education, but do take note of that disclaimer. Before we get on to the main event, just to introduce who we've got here. I know I recognize a lot of the names in the chat from coming to these webinars, but speaking here today, well, Ben, who has over 25 years global investment research experience, having held roles as global equity strategist, global head of sector research, and head of America's research at HSBC in New York. Prior to coming to eToro, he was CEO of an independent research firm, Tower Hudson in London, and has held roles at JP Morgan, UBS, and Rothschild. What a CV that is. And then Gil, who has been Chief Investment Officer here at eToro since 2019. Gil started his career in the financial services industry 2002. And between 2012 and 2019, before coming to eToro, he was CEO of an Israeli ETF company where they would offer dozens of ETFs on global indices, both for retail and institutional investors. To put it very simply, we are in very, very good hands. Ben, Gil, how are you?
I'm feeling great. Thank you, everyone, for joining us today.
Thanks for raising the bar, Sam. We're going to try and hop over it.
Well, look, to begin with, and Ben, you will know this from our weekly Outlook webinars. I love a poll, and I want everyone to have a vote on this. And I'm just going to bring it up for if everyone looks where the slides are, and I can highlight this for everyone right now. So just before we get into the content, I just want everyone to have a look here, and in everyone's view for 2022, how do we see equities performing? So the options are here: down over 10%, down 5 to 10%, down 0 to 5%, up 0.5, up 5 to 10, up 10 to 15, or for those that are maybe more bullish, up over 15%. So please do have a vote. If anyone can't see the poll, just let me know and I will explain where that is. But yeah, I'm looking forward to the session ahead. We've got lots of things to cover. I'll leave that poll up there for a moment before we get the poll results. Ben or Gil, have you got any insight? What do you reckon the results are going to show from our audience before we show them?
I think people are pretty bullish. We'll see.
Yeah.
Interesting. I mean, the street's quite cautious. If I look at what consensus expectations are for next year, I mean, I see someone's put the Morgan Stanley numbers in the chat, which are pretty bearish. I think people are going to be more bullish than that, but we'll see.
Let's see the mood of the investors here. Very interesting to see the results.
If anyone can't see the poll, just let me know. You should be able to. I'll just wait a couple of moments. Okay. Well, I'm going to pop in the answers now. Okay, so there we go, and I think everyone should be able to see that the winning percentage anyway, 34.2% of our audience going for up 5 to 10%. Most bullish scenario up over 15%, 9.4, which I suppose is interesting. Only a few people really going for down over 10%, which would be a shock to me anyway. But Gil, I guess a great way to sort of start this is to go into our first section on the remarkable rally and putting that into context, really.
Yeah, you know, Sam, if I would have told you almost 2 years ago after the pandemic started that we are going to see both 2020 and 2021 ending with double-digit positive performance, so you would probably never believed me. But here we are, aren't we? And looking ahead towards 2022, I think that it would be fair to say that there is a good chance to see another good year in capital markets. S&P 500 maybe to reach 5,000, maybe 5,100 points. And why is that? You know, after the pandemic started, we've seen governments pouring a lot of money into the economies to support the population. And as a result of that, so the situation now is better. The expected GDP, global GDP for next year is around 5%, which is double than the historical average, which is impressive, isn't it? And you know, maybe to mention the alternatives, or should I say the lack of alternatives, bond yields are low. The combination of a high inflation, for one hand, 6% in the US, we just saw this morning, the UK surprised us with more than 4%, and very low interest rate, around 0 in the US, around 0 in the Eurozone, means that if your money sits in cash, you actually lose money, isn't it? So this is another driver for equity markets, but we should continue to be diversified, not to be fully invested just in one company or one sector. And mentioning diversification and sectors, this is also a question of the right valuation. So maybe it's a good opportunity to hear your thoughts, Ben, about that. What do you see next year about the right valuation and the alternatives?
So, I mean, bring it back to first principles, right? There are only two ways to make money in equities. One is, you know, either we get higher profits and higher earnings, one, or two, we're prepared to pay more for those earnings, and that's sort of, you know, valuations going up. I guess, you know, the good news is I'm pretty positive on both those sort of for next year. I think, you know, if we just take it one at a time, so earnings growth, so next year, consensus, you know, is looking for earnings growth, both in the US and globally, of 7 to 8%. And that's going to be down from something like 50% you know, this year. So expectations are pretty low, I would argue. especially given your backdrop of well above average sort of GDP growth. So I think we could be seeing 15 to 20% earnings growth next year. So double what the market, quote unquote, is sort of thinking right now. So basically, I'm arguing for a sort of rerun of what we've just seen in third quarter numbers. That revenue growth, sort of sales growth, driven by these reopening economies, and this sort of above average growth, more than offsets any of these sort of inflation and cost pressures that we sort of hear all about that are sort of bubbling away, and that these profit margins stay, very, very high. Remember, a lot of these industries, these sort of reopening sectors are, their profit margins are still very, very depressed. They still have to a tech sector, which has these very, very high, and I would argue sort of very sort of resilient, resilient margins. So that's the earnings side. I mean, I'm pretty bullish there. And then the other side of this is just sort of valuations, and I guess this is where people are sort of most focused on the risks. Valuations are very high. There's no two ways about it. The S&P 500 price earnings ratio for next year is about 22 times. That is about 30% above the long-term average. So I think it's definitely coming down. I'm not going to sit here and argue it's going to go up, but I just don't think it's coming down very much at all. And I think there's two reasons for that. So I think the first one, which you touched on, is just interest rates and bond yields, I think, are going to rise a little bit, but they're still going to be a fraction of their sort of long-term average levels. And I think that's going to help keep valuations up. And I think the other one is just tech. The tech sector, which is expensive, deserves to be expensive, has these huge margins, has this strong growth, is now basically twice the size of what it was sort of 10 years ago. And so, I think that combination is going to keep keep valuations pretty high. So that's the combination, I think, for next year, which is, better than expected earnings, and these very low expectations, which are going to be beaten, and these very high valuations, maybe coming down a little bit, but basically staying, pretty high. You multiply one by the other, and I think that's what gets you to this, I would argue, close to double-digit return for next year.
Fantastic. Well, it sounds good to me, certainly from a selfish point of view. So look, the last poll, 34% saying 5 to 10, 10 to 15, 20%. So the majority is at least partly bullish. The next poll we've got for everyone should be on all of your screens right now, and it's a simple one. Which country do you think will perform best in 2022? Now, you might think all of them will, but I want to know which one do you think will perform best from a percentage return point of view. So the options there are US, Europe, Asia, UK, emerging markets, and Japan. So feel free to put your answers into the poll there as well. And I was just having a look through the Q&A, some great questions there, and I'll bring up a couple of those towards the end of the session, but keep populating that Q&A chat for us. I'll leave the poll up for another sort of 10, 20 seconds. I know in my mind, I know what I think is going to be the winner here, but I'm not going to give it away. Ben or Gil, what do you reckon? What do you think the audience are going to go for here?
Well, last year people were betting on China and see what happened. So, you can expect the unexpected. So, interesting to see the thoughts of our investors on that.
Yeah, very true. Very true. Right. Okay.
I'm going to guess it's not going to be Japan.
Yeah. I would agree with that. Okay. Last 5 seconds. 5, 4, 3, 2, 1, and the answers are in, and the winner, as I would have gone for, 40% there for US, Europe coming in with 12% of the votes, Asia taking second place, 22%, and then small figures for the UK, which Ben and I won't be too happy about, and then emerging markets, 14% there. But Gil, I guess this passes it on quite nicely to you, and the sort of US exceptionalism versus the rest of the world opportunities.
Yeah, it looks people feel good with the US equity markets. We do share this feeling, even though I must say I heard people asking about, main indices in the US that are at all-time high. So isn't it too expensive at the moment? And I think that the answer is no, because this year the main indices were led mostly by the big ones, isn't it? Apple and Google and Microsoft and Tesla and Facebook, while there are many more companies that did not recover fully yet from COVID-19. So there is still more to go. But there is also good alternatives outside. Ben just mentioned the valuation, and we all know that generally speaking, the valuation out of the US of companies and sectors are much lower compared to the US, which means maybe more attractive. And, you know, just for the sake of the discussion, to mention a few countries, China, I said that before, the China market could be very cheap at the moment. So if things will calm down in terms of restrictions and regulation, so it could be a very interesting investment for the next year. We know that Taiwan and Korea are riding on the tech wave. The UK and the European markets could be in a very interesting spot for investors. So definitely, I would not go to be fully invested just in the US. And by the way, next week on the 24th, we have a very interesting session discussing this in particular. We have the discussion with our eToro analyst to try to analyze internationals versus US equity market. So if you are interested and you want to hear more, so please feel free to join us next week as well.
Yes, absolutely. And guys, feel free just to go to the eToro Academy, where you can sign up for all the future webinars that we do, but in particular these 2022 outlooks. And I'm really looking forward to the session next Wednesday, same time, actually 1 p.m. UK time for us here. Next poll then, and we're going to focus here a little bit more around sectors that you guys think will perform better next year. So the options that we've got, and please do all vote. So we've got tech, energy, financials, real estate, consumers, and healthcare. So let us know, what sectors in particular do you think are going to perform well next year? Seeing some great questions in the chat. One about crypto in general. So we've got the crypto webinar tomorrow, same time. And again, you know, you couldn't get the push notification from the platform, but you can also go to the eToro Academy to sign up for that. Really looking forward to that one as well. I'll leave the poll up for a little bit longer, just so everyone can get their votes in. Just having a quick look through the Q&A as well. Some great questions coming through. Fantastic. Right, last 10 seconds. Get your final votes in. It's the last poll of the day, so if you haven't voted, now's the chance to get your say. Okay, 5 seconds. Here we go. Yeah, I mean, well, did this surprise anyone? I would say is my answer. But tech winning 55%, energy 22s, hardly anything for real estate. Well, this passes on quite nicely to you, Ben. Well, firstly, a surprise for you here at all, anyway?
Not really, although it sounds like I might need to tread a little bit carefully in my following comments. Lucky it's online. I'm not going to get lynched in person. So it's interesting, right? It doesn't surprise me. I guess my comments would be, you know, as I sort of think about sectors for next year, and just, I guess, tying it back to sort of the macro, the sort of top down that we were just sort of talking about, I think earnings are going to surprise next year. I think sort of GDP growth is going to, you know, remain pretty strong. I think that's going to help a lot of people. And really, you know, the people I think I'm looking to invest in those sectors that are going to most benefit from that environment of still pretty strong growth. And that, I think, is going to be the sort of so-called cyclicals, right? So, you know, the commodities, the industrials, you know, the financials, you know, more thematically, you know, people like small caps, and, you know, the sort of quote unquote reopeners. So, you know, travel, transport, tourism, the people that are still sort of most depressed from the pandemic. That's where I think you're going to get the biggest bang for your buck if, you know, we get these sort of 5% GDP numbers sort of next year, you know, double sort of long-term averages of, you know, in the US and Europe. That's one reason to own them. I think the other reason to own them, you know, go back to what I said before, I think the biggest risk out there is that, you know, these very high valuations, which, you know, I think are navigable, but, you know, it is the risk that they come down more. And the beauty of these more sort of cyclical sectors is how cheap they are. So that, you know, gives you a lot of sort of defense to the biggest risk. So, you know, financials and energy, you know, two of the more cyclical sectors, are also the two cheapest sectors, you know, in the market right now. So, you know, those would be my sort of favorite sector segments for sort of next year, the sort of cyclical, small cap, reopeners. You know, on tech, I mean, I see everyone favors it. You know, I'm not bearish on tech. I just think it's a different story. You know, I think it's a sort of longer term, more structural growth story. I think it's less sensitive to the, you know, the growth, the GDP story sort of here and now. But I do think it's very well supported. You know, you've got these very strong sort of fortress balance sheets in much of the sector. You know, they can fund these high growth rates and pay you sort of dividends and buy back shares and things like that. So I think tech's going to be fine. I just don't think it's going to lead like it did last year and like it's done, you know, sometimes this year. But I think tech's fine. I think the people that do lag, and it, you know, it looks like we might agree on that with your poll, is, you know, the sort of so-called defensives, like so healthcare, utilities, you know, telecoms. You know, these are the sectors that are least sensitive to this sort of growth, this strong growth environment where the earnings, you know, aren't going to move as much, where I think they're going to be quite low. But also, you're very sensitive to higher bond yields, which I do think we're going to see. You know, these segments are often called sort of bond proxies because they're very sensitive there. So, you know, as bond yields rise, you know, the present value of those future cash flows will be lower. So, you know, I think markets are going up, you know, call it 10% next year. I think it's led by the cyclicals. I think tech does fine, but call it a neutral. And I think the relative laggards are going to be these sort of defensive and bond proxy sectors.
Yeah, which is sort of the vibe from the poll there on the defensive side of things. So yeah, cool. So sectors we've covered. Next up, it'd be great to get your thoughts and just, you know, potential themes to consider for next year. What's on the radar? I can't hear you, Ben. I think on mute.
I mean, I'm talking to myself. So it's a great question because thematic investing is really booming. And what are we talking about here? We're basically talking about investing in sort of themes unconstrained by geography. And really, you know, the reason it's booming is it's very suited to a lot of the things we're talking about right now. So, you know, tech disruption, you know, the carbon transition, you know, none of these things really respect the sort of traditional sort of geographic or I think assets invested sort of thematic strategies have more than quadrupled in the last couple of years, made a fraction of the sort of broader investment world. So I think they're going to keep growing. You know, we have, I think, 45 what we call smart portfolios up on the eToro platform. You know, a lot of them are sort of very thematic, and you know, I look at them and it's really interesting what's, you know, done well and what's done badly. You know, what's really led this year, I guess, unsurprisingly, anything related to crypto, but also, you know, energy, vaccines, you know, big tech, sort of lagged, you know, online retail, gene editing, cannabis, you know, anything related to China. But you know, if I look ahead, I have sort of 6 things that I think get me excited for next year. I think on the sort of very long-term side, you know, renewables. We've obviously just come through COP26. I think that's really shone a light on this sort of accelerating carbon transition. We basically need, if we have any chance of getting to net zero in the next couple of decades, the renewables investment needs to triple today. So that's one. You know, EVs is obviously related to that. Electric vehicles. You know, only 1% of the cars out there today are electric vehicles. And that number, if you take the most conservative numbers I can find, that number basically goes up 12-fold by the end of the decade. So in the next, less than 9 years, right? So just a huge growth story. And I guess, we'll see that. So, Lucid, Rivian, Tesla, but just a huge, huge growth story, which has barely started. And then just somewhat more cyclically, we talked a little bit about sort of, the reopeners, tourism, hotels, airlines, things like this. But, 45% of the world is now fully vaccinated. There's new treatments launching, feels like almost every day. Life is slowly getting back to normal, or at least we're getting more used to, life, as it is. So I think that's going to benefit these sort of reopening stories. And China, Bill touched on it, worst performing, big market this year. A lot of concerns out there, but I think, over the course of this year, they've become very well priced. And I think that's been a big difference. So I think, the outlook for somewhat better performance, from here, and China still remains, a real global leader in some of these tech segments, whether it's 5G, whether it's AI, or whatever. Crypto, I think, continues to do well. We have a segment dedicated to that, sort of coming up, but just this story, more use cases, and the metaverse. We've obviously been hearing a lot about that with the sort of Facebook sort of pivot, but huge amount of investment going in there. And I would maybe look at some of the gamers, right, that really sort of the first movers in the sort of metaverse. You could maybe see some activity going in there. But we have a webinar coming up, I think next Thursday in a week, just on themes. So we can go into a lot more detail. And as I say, I think themes are absolutely worth considering. As an addition, not as a replacement, but as an addition to traditional country and sector portfolios and investments.
Yeah, absolutely. Yeah, next Thursday, so it's the 25th of November at 10 a.m. GMT. You get the push notification, check your emails, go to the eToro Academy. There's no excuses not to be there, guys, whether it be live on demand, but of course, it'd be great to have you here live with us. Okay, well, look, I've been going through the Q&A, and I'll go Gil with this question here, and I'm actually really keen to get an answer on this as well. It's a common one that I've seen. What would make you turn bearish?
Wow. It's a good question. We are positive the whole session, and now a question about what would turn me bearish. So, we are dealing with capital markets. So theoretically speaking, everything can get wrong, isn't it? But more seriously, I would say that one concern that we should take into account is obviously the inflation. Because if the global inflation will get higher and for the longer term than expected, so it may lead central banks to raise the interest rate sooner and maybe higher than expected. And this is something that capital markets don't really like, isn't it? But I have to say that we don't see it as a main scenario because, think about it. It makes sense that after this serious recession, after governments spend so much money to support the population, so we will see inflation around. But we do think that it's a temporary inflation, and it will be better over the time during 2022. So that's why we don't see it at the moment as a main scenario. So I'm still bullish.
Fantastic. That's what I wanted to hear. Guys, in the chat, in the Q&A, I want everyone to give me a reason in your head, worst case scenario, what could be the tipping point for equities next year? I know it's very hard to pick these black swan events because they're exactly that. You can't predict them. But it'd be interesting to see what people think. Another question I've seen a fair bit, so I thought, Ben, we'll go to you on this one. And just sort of regarding sort of disruptive tech stocks and the view on that, is it time to sort of look at bigger tech?
So yes, again, gross generalization here, right? But I do think that sort of bigger, more established tech names, will do better in the environment that we sort of see for next year. So if I take the other side of that, so the most disruptive and fastest growing sort of tech names, the least earnings, they're also the ones that have the highest valuations. and they're also the ones that are sort of most dependent on the equity market for, funding their business models and giving them the cash to, get them across to then generating, their own cash and funding their own investment. And I do think that model will see some headwinds next year. Maybe not dramatic ones, but we are going into an environment where, growth is going to be somewhat lower. Earnings growth, GDP growth, it's still going to be good, but it's going to be less good than, than this year. And the costs of financing are going to be going up. Interest rates are going to go up next year. Bond yields will probably be higher next year. So I think, the financing costs are going to be higher. So, I do think people are, going to be prepared to pay less for some of these companies. They're going to be more cautious about funding them. And I think from an investor point of view, that means you need to be a bit more discriminating. Sort of by definition, some of the most exciting companies in the world and some of the biggest cap stocks in the future are going to be coming out of that segment of the market. But I do think you need to be, a bit more discriminating. And I do think you need to be tilting towards sort of big tech. So-called FANGs, if you want to use the shorthand. But, that's where I think valuations are, particularly low. That's where cash flows are much stronger. And as I said before, these are the stocks that can afford still strong growth, afford to invest in that at the same time as, still giving cash back to shareholders, buybacks, dividends, et cetera, et cetera. So, I'm as excited as the next person about these very high growth themes and sort of EVs and things like that, as we just sort of talked about. But, I do think you need to, stay diversified and recognize that, next year is probably going to be one where you're going to have to be a bit more discriminating and work a little bit harder to sort of generate the returns.
Yeah, fascinating. And obviously you mentioned FANGs there briefly, and with Facebook changing their name, I'm still calling them FANGs. I'm not changing that. Guys, look, thank you very much for joining us. And in the chat, I've noticed quite a few questions on crypto, and what better way to answer those than tomorrow at the same time. So please make sure you are all here for that on crypto, the 22 outlook. We've also got the international opportunities one, which will be next week, and we go into themes, which I'm really looking forward to. I think the smart portfolios are just such an amazing addition on eToro as well. And yeah, plenty more to come down through the weeks. You can sign up through the eToro Academy, or as mentioned, you also get a push notification on your eToro platform. Gil, Ben, it's been great to have you both on, and yeah, thank you very much.
Thank you very much, Sam. Thank you, everyone, for joining us today.
Take care, everyone. Have a great rest of your day. Bye now.
Bye-bye.